What if I told you that a single $100 bill could be the first step toward building $10,000 in wealth? Most people hear a number like that and immediately assume it requires luck, insider information, or taking massive risks. But throughout American investing history, countless ordinary people have turned small amounts of money into surprisingly large portfolios by following simple principles and staying consistent. The truth is that the stock market has created more millionaires than almost any other wealth-building tool available today. Yet many beginners never start because they believe they need thousands of dollars to invest. In reality, the journey to $10,000 can begin with just $100. In today's video, we're breaking down exactly how investors can use smart strategies, compound growth, and long-term thinking to potentially transform a small investment into something much bigger over time. The first thing to understand is that turning $100 into $10,000 is not about finding a magical stock that explodes overnight. Social media often promotes stories about traders who turned a few dollars into fortunes in days, but those stories usually leave out the huge risks and losses involved. Successful investing is generally much less exciting and much more predictable. Instead of gambling on speculative stocks, experienced investors focus on buying ownership in quality companies that generate profits, grow revenue, and continue creating value year after year. When you buy shares of strong businesses, you're participating in their future growth rather than simply betting on price movements. Let's put the math into perspective. To turn $100 into $10,000, your money must grow 100 times. While that sounds impossible at first, history shows that some companies have delivered extraordinary returns over long periods. Investors who identified innovative businesses early and held them through years of growth often experienced returns that seemed unbelievable when they first invested. The key lesson isn't that you need to predict the next superstar company perfectly. The lesson is that significant wealth is often built through patience rather than constant trading. One of the most powerful forces working in an investor's favor is compound growth. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, and whether he actually said it or not, the principle remains true. Compounding occurs when your investment gains begin generating gains of their own. Imagine earning returns on your original money, then earning returns on those returns, and continuing that cycle for years. This process may seem slow initially, but over time it can create dramatic results. Many investors underestimate how powerful compounding becomes after a decade or more. Another important factor is consistency. Many beginners focus entirely on the first $100 while ignoring future contributions. In reality, adding money regularly can dramatically accelerate growth. Suppose an investor starts with $100 and continues investing every month into diversified stocks or index funds. Even modest monthly contributions can significantly increase the likelihood of reaching larger financial goals. The stock market rewards discipline far more often than it rewards short-term speculation. This is why many financial professionals recommend broad market index funds for beginners. Instead of trying to pick individual winners, an index fund provides exposure to hundreds of companies across different industries. This diversification reduces risk while still allowing investors to participate in overall market growth. Over long periods, the U.S. stock market has historically delivered strong returns, making diversified investing one of the most accessible strategies for building wealth. For many Americans, contributing to retirement accounts, such as a 401k or IRA, index funds form the foundation of their long-term investment strategy. Of course, risk management is equally important. Many new investors become attracted to penny stocks, meme stocks, or highly speculative investments because they promise quick riches. While a few people may experience large gains, many others lose substantial amounts of money chasing unrealistic returns. Successful investors understand that preserving capital is just as important as growing it. Avoiding major losses allows your portfolio to continue compounding over time instead of constantly recovering from setbacks. A common mistake is allowing emotions to drive investment decisions. When markets rise rapidly, people often become overly optimistic and buy at inflated prices. When markets decline, fear causes many investors to sell at exactly the wrong moment. History has repeatedly shown that markets experience periods of volatility, corrections, and even bear markets. Investors who remain focused on long-term goals rather than short-term headlines are often rewarded for their patience. The ability to stay invested during uncertainty can become a major competitive advantage. Technology has also made investing more accessible than ever before. Many brokerage platforms now allow fractional shares, meaning investors can buy portions of expensive stocks without needing hundreds or thousands of dollars. This enables beginners to start building diversified portfolios with relatively small amounts of capital. Instead of waiting until they have large sums available, investors can begin immediately and allow time to work in their favor. Tax efficiency can further enhance long-term results. Accounts such as Roth IRAs offer potential tax advantages that allow investments to grow without future qualified withdrawals being taxed. Understanding how taxes affect investment returns can make a meaningful difference over decades. While investors should always follow IRS rules and consult qualified professionals regarding personal situations, taking advantage of available tax-advantaged accounts can be a powerful component of a wealth-building strategy. It's also important to recognize that investing is not a get-rich-quick scheme. The journey from $100 to $10,000 may take years, depending on investment performance, contributions, and market conditions. However, the habits developed during that journey are often more valuable than the final number itself. Learning patience, discipline, research, and risk management can create financial skills that benefit investors for the rest of their lives. Imagine two people starting today. One person spends $100 on something that loses value immediately. The other person invests that same $100 and continues learning about personal finance, investing regularly, and allowing compounding to work over time. Years later, the difference between those decisions could be thousands or even tens of thousands of dollars. Wealth creation often begins with seemingly small choices repeated consistently over long periods. The most important takeaway is that the first $100 matters because it creates momentum. It transforms investing from an idea into an action. Once someone becomes an investor, they begin viewing money differently. They start looking for opportunities to save, invest, and build assets rather than simply consume. That mindset shift is frequently the true beginning of long-term financial success. So can $100 become $10,000 in the stock market? Absolutely. But the path usually involves patience, discipline, intelligent investing, consistent contributions, and a commitment to long-term growth. The investors who achieve remarkable results are rarely the ones chasing shortcuts. They're the ones who start small, stay consistent, ignore distractions, and allow time and compounding to do the heavy lifting. Your first $100 may not seem life-changing today, but it could become the foundation of a much larger financial future. The question isn't whether $100 is enough to start investing. The real question is whether you're willing to start today and give your money the time it needs to grow.